is to know the difference between an asset and a liability and to buy assets. The rich focus on their asset columns while everyone else focuses on their income statements. That is why we hear so often, "I need a raise. If only I had a promotion. I am going back to school to get more training so I can get a better job. I am going to work overtime. Maybe I can get a second job." In some circles, these are sensible ideas, but you are still not minding your own business. These ideas all still focus on the income column and will only help a person become more financially secure if the additional money is used to purchase income-generating assets. The primary reason the majority of the poor and middle class are fiscally conservative, which means I can't afford to take risks, is that they have no financial foundation. They have to cling to their jobs and play it safe. When downsizing became the in thing to do, millions of workers found out their largest so-called asset, their home, was eating them alive. Their asset was costing them money every month. Their car, another asset, was eating them alive. The golf clubs in the garage that cost $1,000 were not worth $1,000 anymore. Without job security, they had nothing to fall back on. What they thought were assets could not help them survive in a time of financial crisis. I assume most of us have filled out a credit application to buy a house or a car. It's always interesting to look at the net worth section because of what accepted banking and accounting practices allow a person to count as assets. One day when I wanted a loan, my financial position did not look too good. So I added my new golf clubs, my art collection, books, electronics, Armani suits, wristwatches, shoes, and other personal effects to boost the number in the asset column. But I was turned down because I had too much investment real estate. The loan committee didn't like that I made so much money from rent. They wanted to know why I did not have a normal job with a salary. They did not question the Armani suits, golf clubs, or art collection. Life is sometimes tough when you do not fit the standard profile. I cringe every time I hear someone say to me that their net worth is $1 million or $100,000 or whatever. One of the main reasons net worth is not accurate is simply because the moment you begin selling your assets, you are taxed for any gains. So many people have put themselves in deep financial trouble when they run short of income. To raise cash, they sell their assets, but their personal assets can generally be sold for only a fraction of the value that is listed on their personal balance sheet. Or, if there is a gain on the sale of the assets, they are taxed on the gain. So again, the government takes its share, thus reducing the amount available to help them out of debt. That is why I say someone's net worth is often worth less than they think. Start minding your own business. Keep your daytime job, but start buying real assets, not liabilities or personal effects that have no real value once you get them home. A new car loses nearly 25% of the price you pay for it the moment you drive it off the lot. It is not a true asset even if your banker lets you list it as one. My $400 new titanium driver was worth $150 the moment I teed off. Keep expenses low, reduce liabilities, and diligently build a base of solid assets. For young people who have not yet left home, it is important for parents to teach them the difference between an asset and a liability. Get them to start building a solid asset column before they leave home, get married, buy a house, have kids, and get stuck in a risky financial position, clinging to a job and buying everything on credit. I see so many young couples who get married and trap themselves into a lifestyle that will not let them get out of debt for most of their working years. For many people, just as the